Hello viewers, let's talk about the exploration of market cycles and how to invest accordingly. Market cycles are recurring patterns of economic expansion and contraction that impact financial markets. Understanding these cycles can help investors make informed decisions about when to buy, sell, or hold investments. Here's an exploration of market cycles and strategies for investing accordingly. 1. Phases of the market cycle. Expansion. During the expansion phase, the economy grows, corporate profits rise, and investor confidence is high. Stock prices typically increase, and riskier assets may outperform. This is a favorable environment for growth-oriented investments. Peak. At the peak of the cycle, economic growth peaks, and signs of excess may emerge, such as overvaluation of assets or speculative bubbles. Investor optimism is at its highest, but it may be a signal for caution as markets become vulnerable to correction. Contraction. Recession. In the contraction phase, the economy slows down, corporate earnings decline, and investor sentiment turn negative. Stock prices fall, and defensive assets like bonds and gold may outperform. It's a challenging time for investors, but opportunities may arise for value-oriented strategies. Trough. The trough marks the end of the contraction phase, where economic indicators bottom out, and investor pessimism is widespread. This may present buying opportunities for long-term investors, as asset prices are often undervalued relative to their intrinsic worth. 2. Strategies for investing across market cycles. Diversification. Diversifying your investment portfolio across asset classes, sectors, and geographic regions can help reduce risk and mitigate the impact of market cycles. By spreading your investments, you can capture opportunities for growth while protecting against downturns. Asset allocation. Adjusting your asset allocation based on where we are in the market cycle can help optimize risk-adjusted returns. During the expansion phase, overweight equities for growth potential. In recessionary periods, increase exposure to defensive assets like bonds and cash. Active management. Active portfolio management involves monitoring market conditions, analyzing economic indicators, and adjusting your investment strategy accordingly. By staying informed and agile, active investors can capitalize on opportunities and manage risks across market cycles. 3. Risk management. Regardless of your investment strategy, risk management is crucial across all market cycles. Diversification, asset allocation, and periodic portfolio rebalancing can help manage risk and preserve capital during market downturns. It's essential to assess your risk tolerance and invest accordingly. In conclusion, understanding market cycles and investing accordingly is essential for long-term investment success, confidently navigating market cycles, and achieving your financial goals over time.